Howdy. Good morning. I am your token economist. It is always necessary to start out a presentation like this, a session, with sort of the 100,000-foot view of what's going on in the economy, what's going on in the housing market, and some outlook into the future of the nature of the real estate industry, and particularly here in the Austin area. For those of you who are not familiar, this is the 10-second commercial. The Real Estate Center is a 38-year-old organization. It is unique in the state of Texas. It is funded by the licensees, the realtors that Jay is referring to here this morning. They support the Real Estate Center, and our mission is to be the providers of data and analyses and research and outlook on what is happening in the world of real estate at all levels to help people make better decisions. And our mission, our goal, is oriented as much to the general public and everybody in the state as it is to the industry. And to that, I invite you to come to our website, recenter.tamu.edu, and please avail yourself of all of the data, all of the information, the market reports. You'll find a wealth of data there. We have a very heavy charge for so much of our stuff. It's free. That's what the industry is paying for, and it is unique. There is not another center like this in the United States. We know because we get constant calls from around the country from people wanting to know, how do I get information about my real estate market like you have for Texas? And we're not aware of anybody else doing this. So please avail yourself. I found a quote the other day from a politician, and I thought it kind of summarized where we are and maybe what we've learned in the last 2,000 years in running the organization, running the country. And it says, the budget should be balanced, the treasury should be refilled, public debt should be reduced, the arrogance of officialdom should be tempered and controlled, and the assistance to foreign lands should be curtailed lest Rome become bankrupt. People must again learn to work instead of living on public assistance. I thought you'd like to know which politician uttered that. That was Cicero in 55 BC. So what it tells us is in 2,000 years, we really haven't learned a damn thing about how to run anything. But I thought it was real interesting quote. Any of our politicians today could probably give this, and I need to temper this because right through that wall I think of the Republicans. So I'll have to temper some of my remarks here this morning and understand that they're probably, glasses to the wall over there. Let me give you the 100,000-foot view of the economy. What's been going on? It can be summarized sort of into these areas. Credit contraction. Banks, of course, as you well know, got into a big trouble. Last fall, we had a real crisis in the financial system. For all of last year, really, technically, all of the major banks in the United States were insolvent. If you actually did their balance sheets correctly, you would have discovered they had inadequate reserves according to regulatory requirements. They had the so-called toxic assets. They had bad loans. They had bad paper. And so basically, they had no reserves, and they quit lending money. Now, you have to understand, we have a free market capitalistic system in the United States. It's funded on two basic principles. The two principles are greed and use other people's money. In business school, that is taught as profit maximization and financial leverage. And that is what has happened. We didn't have the credit. The credit not only contracted, it actually froze. And we're talking credit not only for buying houses, but for businesses, for the other banks, commercial paper, everything across the board. Asset deflation, the last 25, 30 years, what's been the buzzword with the Federal Reserve Bank has been inflation. This year, it's deflation. Prices are actually going down. I got some data for you here in a minute. You know an economist can't get up and not show you some charts and graphs of data. But we've had asset deflation. Leading to that is household wealth devastation. In 2008, the Federal Reserve estimated that the net worth of the households in the United States declined $12.5 trillion. That's a trillion with a T. That's a lot. In the first quarter of this year, January, February, March, it was estimated that households lost another $1.3 trillion. And it is estimated by the end of this year, we may lose another $3 or $4 trillion. What was all the loss? Home value declines across the country. Your 201k now just isn't worth what it was before. Your savings account, your personal accounts, and the value of the dollar, all of your assets have deflated. Profit compression, I said it was greed and other people's money. What makes the world work here in this kind of capitalistic system? Companies have to make a profit. Every company has to make a profit. If they don't make a profit, what do? They cut back. They constrict themselves, they let people go, you have unemployment, and ultimately, we may even see a couple of bankruptcies and things like with Chrysler, General Motors, AIG, and some others. We've lost employment. We've lost about 5.25 million jobs in the last year and a half. We'll probably lose about 500,000 more before it's all said and done this year. The pundits are saying that hopefully by the end of this year, the fall in jobs, the loss of jobs will stop. I'm not sure that will happen exactly on the calendar exactly, but it should start showing some improvement. Inventory, that's a technical thing. What we've got is we've got excess capacity now in the United States that when we have recovery and the economy comes back, everyone is counting on this available capacity to increase our business activity without having astronomical inflation. Remains to be seen whether that'll happen. The end result of all this, of course, is greater federal intrusion and government regulation. 70% of the U.S. economy, 70% of the U.S. economy is based on people going out and spending money, buying things, personal consumption. And for years, we were doing great. I mean, we were going out to the mall every Saturday and spending 110% of what we had. Savings rate went negative. People were buying things, which meant people could sell things, they could make more things, more goods and services. It stimulated everything. Well, that 70% declined, and it declined really for the first time. I've got another graph on that. The other is government, corporate spending. Corporate spending is basically stopped for the last 6 months to a year. Corporations are not only not spending, they're contracting, they're laying people off and so on. So it only leaves government. We have a three-legged stool. That was the third leg of the stool, and government is now stepping in to try and stimulate. You know, the Fed and the Treasury has been extremely active. We've committed almost $3 trillion in the form of stimulus and bailouts and everything else. Have you seen the new dollar that the Treasury has designed that we're going to all have next year? It's going to look like this. And George is rolling over, but that is indicative of what has been happening. Let me give you some data, some statistics. GDP, which is our basic measure of how well the economy is doing. You can see that out here on the far right, that 4 of the last 6 quarters have been negative. The official date of start of the recession was December of 2007. We're in now the 19th month, or we will be as soon as we get in July. It's the longest recession we've had since World War II. It will probably wind up being the longest prolonged down cycle time that we've had since the Great Depression of 1929-1934. I've got a chart that we've used on other things for that. Inflation, we were talking about. I'm not sure how well you can see that red line through there. That's the zero line, and you can see that overall inflation on the CPI has dropped below zero, running about 1% on an annualized basis of actual price declines. Now, in general, most of us are in favor of that. I'm real happy when the price of things come down. I can buy more things. The price of gas goes down. Price of this goes down. Go see a movie. You can't go for a movie for $25 anymore. You can get in for 20. Hey, that's a good deal. But the economy does not function well if there isn't growth, expansion, and that generally means some level of price increase. So price deflation does not hold up well for very long as being a good thing. Consumers, we talked about it being 70% of the economy. Consumer confidence dropped off almost 50%. It's bounced back up. That's one of those green shoots that you hear about in the news every once in a while. People are looking for any kind of indication of improvement, things getting better, turnaround in the economy. A green shoot, it's like planting plants in the spring and seeing that initial plant come up out of the ground in the green. That's what they're looking for. That's one of them. But I think at 55, the consumer index is not good enough yet to get us back. Here's what I was talking about, personal consumption. Can you see right out there at the end where it's tailed off right up there? The technical term for that is that it humped over. We got a couple of hump overs that I'm going to show you. But you can see how the overall trend in personal consumption has been upward, 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 and then now falling off. And when that's 70% of your economy declines by 5 or 6 or 7%, that's a major hit. That is a major hit on your overall economic stability and growth. Corporate profits, another hump over. You can see how corporate profits were going up. This was the flat period back at the last recession we had, which was 2001. They declined slightly. You can see here they have actually fallen off quite substantially. And when companies do not make a profit, things don't look well for the economy and particularly the job market. Speaking of the job market, this is what it looks like. The U.S. here, the yellow line. Again, here's the red. Can you see it back there, the red line? That's the zero line. You can see how the U.S. Growth in employment has gone completely negative. Texas has finally joined the rest of the country in this recession. We took a pass last year. We didn't join the recession until the beginning of this year, but we have had now about 4 months of continued job loss in the state. But our job losses here have been substantially less than the rate of job loss across the rest of the United States. We're estimating for 2009, Texas job growth will look like a negative 2%, somewhere in that range. U.S. is probably going to be negative 4 to 6%, so it's about half the rate. Do you like Maxine? Do you like the cartoon character Maxine? I love it. I found this one the other day, so I had to make the slide because I think Maxine nailed what's going on with the federal intrusion we were talking about a minute ago. She said she remembers back in 1990 the government took over the Mustang Ranch out in Nevada and for tax evasion. And by law, they had to try and run it and keep it open. Well, it lasted less than a year. The Mustang Ranch failed, went out of business, closed up shop. She says, well, now we're going to trust the economy of the country, the automobile industry, the banking industry, and we could throw in health care to the same nitwits who couldn't make money running a whorehouse and selling whiskey. Now, I thought that Maxine just flat nailed that one, okay? The government is not really set up to run anything. They don't run anything except, they don't make anything except trouble. Anyway, here's what Texas looks like. We're still vulnerable to U.S. conditions. We are not in splendid isolation as much as we would like to think we are. We have now joined the rest of the world. We are subject to all of those contractions going on by major corporations as they have cut back. The banks, the manufacturing companies, all of the goods and services, all the professional services companies and so on. And of course, in Texas, what's the big one? Energy. Energy went through a big run up. It's come down. We'll see some data on that in a little bit. Our job growth could be 1 to 1.5% if there's no major. That ain't going to happen. It's probably going to be about -2. Our housing markets, unlike the rest of the country, and that was what was alluded to here in the video a minute ago, our housing markets in Texas have stayed reasonably strong, much, much stronger than the rest of the country and what you read about in the paper. And we'll get to that in just a minute. I got some more on that. But it's spotty. It is spotty. Now, the next shoe that's going to fall, though, nationally and to some extent in the state of Texas is commercial real estate. All commercial real estate's beginning to hurt. There's been a very, very heavy pressure, downward pressure on rents, occupancy rates, new space. There'll be no new construction in commercial, at least there shouldn't be. It doesn't make any sense anywhere in the country right now. Cap rates, the financial markets and the investment markets are changing, so rates of return now are much higher, and as soon as you increase the cap rate from, say, 4 to 8%, you just have the value of the property. So that's happening. Now, I know there was some sentiment from the room next door that maybe we should become an independent republic again, and if we did, we'd be the 11th largest economy in the world. Most people don't understand how big the economy in Texas is. I mean, we're bigger than the Russians. We're bigger than the damn commies. It's amazing. Of course, we don't really know how big their economy is because about half of it's black market. So anyway, but it's an interesting kind of thing. Here's what's happening in Texas. We had the big run-up in the price of oil. This is West Texas Intermediate crude. You can see it fell off the cliff. Fortunately, the energy companies didn't get carried away with that big run-up. They knew that was phony. They knew that it was not based on supply and demand. By and large, they didn't react. They didn't go out and make wild expansion plans and so on. Now, it did do some things. Oh, you got to be kidding. The rig count is coming down. That's going to affect our employment. You can see that it's more than half. The index of leading indicators put out by the Dallas Fed is down. Now, let me get to real estate. Foreclosures in Texas have been very minor, very mild compared to the rest of the country. In fact, for the year-to-date 2009, our foreclosure filings are actually down 12% over last year, according to Realty Track, while the rest of the country is up 33%. That probably will change as we are now losing some jobs, but it will change. New home sales, the white line, that's the bad news for the home builders. The existing home sales, we just had a bubble. We had a bubble in prices. We had a bubble that looked like this, where the housing boom started. We got way above trend and created this national price bubble that now has burst. And that's what's happening with the price deflation and the wealth loss that's happening, particularly in about eight states in the union. We didn't have it in Texas. The very good news to Texas was we didn't have the price bubble. Median home prices went down about 2% in 07, went down 15% last year. They're down about 14% so far this year, according to NAR. We're probably still going to see negative. Tax credit does seem to be having some implications. Foreclosure homes are beginning to be felt in the marketplace because they generally get discounted so much more in the sales process. When they go to REO, they go into the multiple listing service, they get sold, they generally go for lower prices. Appraisers are right now, they can't win. The appraisal process is just going nuts because they don't know what to use. Sales volume will increase primarily through job growth, mortgage rates being good. They're still very good. They're historically low. And home price affordability. Affordability is going to be the operative word for the next 3 or 4 years. Homes are going to be affordable for those who can qualify for the mortgages. And quite frankly, if you're in the market to buy a house right now and you plan to live there for at least 3, 4 years or more, right now might be the very best time, a once-in-a-lifetime opportunity to do so with the combination of low prices, low mortgage interest rates. But you are going to have to, God forbid, you're going to have a job. You're going to probably have to have some equity, and you're going to have a credit score that will qualify you for the loan. But if you can get in there, this is going to be the time to do it. Let me talk about Texas and Austin real quick. Annual home sales in Texas are still declining somewhat. It mainly is a reflection of the tightening in the mortgage market. It's just so much harder to get a loan. All those factors I just said about qualifying for loan, we're back to the same qualifying standards that we had back in the early 1990s, and quite frankly are historical standards of qualifying ratios, job, documented job, having at least some kind of down payment, etc. But it is cutting back. So what we had is we had not only a price bubble, we had a transactions bubble. And those transactions, that number of transactions simply won't hold up. Here's my other hump over. Our 3-month moving average median price in the state has humped over a little bit. We've got to watch that. So far, that has been holding us up. And I think next year it'll come back. Builders, you can just forget the home builders. They're out of business. It basically looks just like it did back in the 1980s. The percentage declines are about the same. Austin's been doing pretty well. It looks like that 2009 will look like about the 1999-2002 period. It is going to fall off a little bit because of the tightness in the mortgage market. It's impossible to maintain those inflated levels of transactions, but what we're going to come back to is looking something like that. And yeah, there is always an over-adjustment. When things go way up, they'll go way down before they'll come back to trend. And that's what we're going to start seeing. Austin home sales have fallen off. You can see, though, that the trend has been up and down lately. The other thing I haven't mentioned, the high-priced home market is very much off. And that is also causing some of the statistics to look more negative, like the median, because right now the jumbo mortgage market is very difficult. Very difficult to get a high-end loan. You can see the days on, or the months inventory, if you can see this graph very well, it goes inverse with the rate of increase in home prices. The Austin median home price, though, has continued to climb. It's still up. It was one of the few metropolitan areas in Texas last month that still had positive median home price growth, so that's good. The home prices can go up. It's probably going to stabilize for a while and then pick back up. It's had a little bit of kick down. Let me go to the population because I'm running out of time and my timinator here is after me. This is what it looks like for the next 40 years, from 2007 to 2040. What I wanted to do is, Texas is no longer the state of John Wayne and Tex Ritter and Hopalong Cassidy, and I'm showing my age. But it's no longer a rural state. It's very urban. In 2007, 88% of the population lived in a metropolitan statistical area. By 2040, it'll be about 93. I thought you might be interested to see Austin's projected to grow almost to 4 million people by 2040. It's going to be interesting. This is an Aggie triangle. This is the Central Texas Triangle. 84% of the people in Texas live in that triangle. And we expect over the next 30 years it will continue to be about that same proportion. It's basically the 35-45-10 corridor expanded a little bit to show the metropolitan areas. But you can see that that's, of course, you can see with the red stars. It's my graph. Have you thought about what Lake Travis, you know what Lake Travis looks like now compared to like 20 years ago? You know what it'll look like in 2050? It's going to look something like that. I mean, good luck finding a place. Actually, there was a subtitle of that. Where's the restroom? Here's what the projected Texas population, we're about 24 million. We're going to go somewhere between 37 and 41 million. Let me put it in perspective. Over the next 25 years, from 2005 to 2030, we're going to add, on average, about 14 million people. Now, let me put that in perspective. That's the population equivalent in the next 25 years of adding a 12-county Dallas-Fort Worth metroplex, plus a 10-county Houston, plus another 8-county San Antonio, with enough people left over to create another Corpus Christi. That's a hell of a lot of folk. I don't know where we're going to get the energy. Right now, I'd tell you one of the most critical things is not only infrastructure. I mean, Austin's going to add all these people. And incidentally, Austin runs about 1.1 registered vehicle per person. Did you know that? It was the highest in the state. I don't know where you're going to park them, much less drive them. But anyway, it's going to be interesting. And now one of the big concerns is water. Water is going to be one of the big constraints on our growth in the state. Here's what the age distribution, I don't have time to get into it, but what we've got is we've got age, we've got young people. This is 2010. These are kids from 0 to 10. They're already alive. And this doesn't look like the U.S. profile. The U.S. profile, that's a lower group. For Texas, that's a bigger group than the boomers coming through. And it gets bigger, and it gets bigger, and they're Hispanic, and we're going to have to educate them, and we're going to have to house them, we're going to have to retail them, we're going to have to prison them, we're going to have to do all kinds of things to them, and they're coming, and they're already in existence. Austin looks like this. It's about 1.6 million right now in 2007. This is to 2030, so that's different than the 2040 number you saw a minute ago. Projected to grow between 3.5 million people. This is going to be one of the fastest growing communities in the country, and especially in the state. And I thank you very much.